We have a wonderful guest here today. Michael Barr is a professor of law at Michigan Law School. He is also a staff member at the Gerald Ford School of Public Policy. He's a professor there as well. He is an alumnus of the Brookings Institute, has held several positions in the U.S. Treasury. He is one of the chief architects of Dodd-Frank and the CFPA. He has many books that he has written or co-authored, and he's held several positions in the executive branch of government, including as a special advisor to Professor Clinton. He is also a Rhodes Scholar, and he is an advisor to Lending Club. He is going to present to us on a very interesting topic, and he's going to keep it crisp. I've seen his presentation. I think you're all going to enjoy it thoroughly. And Professor Barr is going to speak to us about essentially how people behave and how online lending may empower consumers. And I'm very excited to see this presentation. And without further ado, Professor Barr.
Good morning, everybody. I'm going to talk to you today about lessons from behavioral economics. And I'm hoping that these lessons will help the online lending space empower consumers through better financial innovation, better financial education, and on a basis of a sounder, firmer system of financial regulation. So I think that behavioral economics has important lessons in each of these three areas. And what I'd like to do in somewhat rapid-fire fashion is talk to you a bit about behavioral economics and then show you some of the implications. So in a classical model of human decision-making, the rational agent model, we have, as individuals, we gather information. That information leads us to make a decision. The decision turns into action that produces an outcome in a logically linear fashion and in a predictable way. And what I want to say to you today is that that has value as a model, but it may not accurately reflect the way we make decisions. Anybody knows in this space that we all like to talk about financial issues. We all care about financial issues, but most people don't. Right? Most people find it deathly boring. They'd rather buy a pair of sunglasses than shop around for car insurance, right? For sure. And I think, deep down, most of us would rather pick out a pair of sunglasses than shop for car insurance too. And behavioral economics teaches us that the model that the neoclassical system had doesn't really accurately reflect human decision-making. That information collection doesn't automatically lead to understanding. That intending to do something doesn't automatically result in the behavior happening. That we all have, to some degree, either greater or lesser degree, a set of biases that frame the way that we make decisions and frame the way that we undertake our own behavior. And that we are buffeted in many ways, shaped in many ways, influenced in many ways by the context and institutions of our decision-making. And I want to explain these biases to you maybe in some rapid fashion. I think all of us have moments when we misperceive our own selves, that our vision of ourselves does not accurately map onto who we are and how we act in the world, and that can cause us to make significant mistakes. We misforecast our own behavior. We believe that we're not the kind of person that will be late on our credit cards or overdraft our bank account or go over our credit limits. We have myopia, we're short-sighted, we focus on what's right in front of us, and we miss the bigger picture that may be standing close by. Many of us humans have a decisional conflict. If there are many, many choices of similar things in front of us, we'll have a tendency to pull back and not make a decision at all. So when you go to the grocery store, I don't know how many of you recently picked out OJ, but it has become bewildering to do the most basic task of stopping by on your way home at the grocery store and picking up orange juice. I always get it wrong. I don't know about you. We're very influenced by context, right? Anybody, again, who's gone grocery shopping knows our eye-level purchases are the ones that we're naturally drawn to, even if we think we're making a decision on some other kind of value. Human beings are present biased. We are unwilling to take the step of not eating that marshmallow, even if waiting would get us a second one soon at hand. Even if we think that we've made a plan, we're not going to pig out and eat the plate full of cookies, we tend to be poor monitors of our own planning and decision-making and actual behavior. And all of us, to some extent, use different tools of mental accounting that can often help us to save more by putting aside funds for that purpose, but may also mean that we take advantage of very high-cost borrowing and low-cost, low return saving at the same time. And these kinds of biases can be quite problematic. Many individuals face all kinds of attention constraints. Again, we think as planners or as social scientists or as innovators that we know what decision our customers are making when they come to do business with us. But often in the background, many other things are going on in the person's mind that pull their attention away from the decision that you think is being made at that time. And individuals suffer to a greater or lesser extent from information overload. Too much information makes it very hard to process, makes it very hard to gather the kind of understanding that we need to make effective decisions. And anybody who has filled out mortgage paperwork knows what I mean. And lastly, all of us, to some extent or another, human beings tend to procrastinate. We tend to put off the things that we ought to do today, particularly if they're painful or just, as I said before, boring, right? Who wants to fill out financial paperwork? It seems overwhelming, it seems complicated, it seems painful. We would rather go pick out a pair of sunglasses. And these behavioral insights, I think, can give us important lessons for understanding how this human decision-making actually happens. Instead of a linear process of decision from information collection to decision to action to outcome, we see that the process is much more complicated. The decision is based on a set of frames and biases that shape the way we process information, that alter the way that we frame our decisions. And the decision may not lead directly to action. It might be complicated along the way. There's a famous experiment, for example, that was done with respect to divinity school students who were reading about the Good Samaritan. They were learning about the Good Samaritan. They had to write an essay about the Good Samaritan. And then they were supposed to go deliver remarks, a speech as part of their final exam about the Good Samaritan. And an experiment was done where as they were going to go deliver their lecture, they had to wait in a waiting room. And along the way, there was a man lying on the sidewalk hurt. And half the people were told as they were going to their lecture, they had plenty of time to get to their lecture on the Good Samaritan, and half of them told them, oh no, we've moved up your slot, you have to run, you're late. And so these are divinity school students who are learning about the Good Samaritan. The ones who were told they were late, almost all of them rushed past the hurt man on the sidewalk in order to get to their lecture on the Good Samaritan on time. Whereas the people who were told they had a little extra time stopped and overwhelmingly stopped and helped the hurt man. So these contextual clues can make a huge difference, even on issues where we think our values are deep and abiding and in which we are focused in that moment. So decision and action and outcome are not neatly aligned. Now, this is particularly a problem It's a problem for all of us. It's a particularly acute problem for people who are many of your customers, retail customers, who are living paycheck to paycheck. Retail customers who are a moderate income have no slack. They often have no financial give in their lives. They have no cushion in the event that something goes wrong. So you or I could make a mistake, we could overpay for, we could overdraft on our account, we could overpay for a set of activities, and it doesn't matter in our daily lives. But for somebody who is living on the financial margin, this lack of slack could mean small mistakes build and become significant problems in their lives. A need to make a car repair can throw off the budget of that family and mean that they have no food to eat. Or a lack of ability to repair that car could mean that they can't get to work, they lose their job, and so on. So the lack of slack in families' lives could mean that these behavioral problems mount and lead to huge economic consequences in their daily lives. Now, I've been talking about the individual in the absence, really, of talking about the marketplace, and I want to bring the market to the individual at this time. So, in many contexts, the market works to help individuals overcome behavioral biases. You know, the fact is that the ability to amass savings over time might be reduced by the fact that many individuals find it hard to understand the importance of compounding of interest. And so the financial sector spends time trying to help people understand how saving accumulates over time. But there are other contexts in which the market sometimes organizes to exploit these consumer fallibilities, to shroud prices, for example, or to engage in a set of activities that makes it hard for people to understand the true cost of the goods or services that they buy. And so in different contexts, the market might be neutral towards or in favor of overcoming these biases, and in other contexts, the market might be exacerbating these biases. And in those contexts in which the market is exacerbating biases and competition is not eliminating the outcome, these are circumstances in which we can see enormous harm both to consumers and to the broader economy, as we saw in the devastating financial crisis in 2008. So it's important to have, in going forward in the wake of that crisis, which, as I indicated, was just a massive harm, not just to the financial sector, but to average citizens really around the globe. Going forward, there needs to be a reform process that has three central parts. There needs to be reform of financial education, there needs to be reform of financial regulation, and there needs to be innovation that is designed to help consumers be empowered to overcome these predictable biases, to overcome the infirmities, and not to exploit them, not to take advantage of them. And these three efforts in education, regulation, and innovation can take advantage of the lessons from, the learning from behavioral economics. So, for example, in the area of financial education, instead of spending our time teaching a number of lessons to consumers and then handing them a very long pile of papers to do, of homework, maybe we can help consumers to actually put in place the plans and the efforts that they need to succeed. And this is from work that Antoinette Chor and Piyush Tanchia from Ideas 42 did, explaining to households in a very quick financial health check their situation, and then signing them up for things at that moment that would actually help them. Things like direct deposit and automatic bill payment to take care of recurring problems. Financial regulation also needs to learn from these behavioral insights and to embed those insights in a values-based approach to regulation. Regulation that focuses on simplicity and on transparency, on honesty and fairness and trust. These are values that the regulatory landscape can help to build that makes it easier for consumers to be able to make good decisions. So for example, in the Credit Card Act in 2009, when I was at the Treasury Department, this is one of the areas I worked on, we put in place efforts to help empower consumers with new information about, for example, the consequences of paying only the minimum payment on their credit card. And this helps give consumers a tool to do better over time in making decisions about how to pay off their balances. Similarly, in the Dodd-Frank Act, which I was also deeply involved in, we took a number of efforts to try and create a level playing field in the mortgage space so that consumers could actually understand the consequences of their financial decisions, and that we could take care of potential problems in the market before they led to the kind of devastating results that we saw in the financial crisis. And one such effort was simplifying the rules for mortgage disclosure, moving from a more complicated form under 2 different federal statutes administered by 2 different agencies to a single set of forms administered by the Consumer Financial Protection Bureau that provides more meaningful information to consumers. The Dodd-Frank Act also, as you know, created a new agency, the Consumer Financial Protection Bureau. And the Consumer Financial Protection Bureau is designed to have the flexibility to respond to changes in the marketplace in a rapid fashion, changes in the marketplace before they become a problem going forward, and to raise the standards going forward. And I think this presents some risks and some opportunities for the online lending space. The CFPB has taken action on payday lending, regulation and supervision. They are increasingly looking in the online space, as are state attorneys general. And the CFPB is very focused on debt collector supervision and regulation matters, which is the kind of end point when things go wrong in the lending space, and is an important part of getting the systems right in advance. It may be that the CFPB will take a look at the peer-to-peer lending space in a more systematic way in the future. And I think when the CFPB does, it's incumbent on the sector to be in a position which it can, given its strength and its sparkle and its innovation now, to be operating in a high road fashion. There's obviously also been a ton of oversight by the SEC with respect to the funding side of the online space, and we've heard discussion yesterday that I won't go into detail about the problems and potential for the crowdfunding rules that the SEC is going back, I think, appropriately to the drawing board on today. So behaviorally informed regulation is a tool that can use behavioral economics to improve the systems we have for behavioral, the insights we get from behavioral economics can be used to improve the performance of regulation, consumer protection going forward in a way that creates a level playing field for higher standards. That level playing field, I think, is a better place from which all of you can help to innovate. The level playing field creates a space where you can compete on the basis of ways of enhancing the customer experience and providing better value. And I think that the risks and opportunities of that higher bar, that higher level playing field, lean towards the side of opportunity for the online lending space for a number of reasons. All of you would rather not be spending time being buried under some compliance problem, and you'd rather not be spending time responding to religious leaders protesting your behavior. You want to be spending time innovating. You want to be spending time finding cool new ways to serve consumers and small businesses and the broader American economy. And the way to do that is by taking the high road. And the high road frees you to do the kind of innovation that I think is very exciting. And the financial innovation that you're working on, to my mind, should be focused on those same sets of values that I talked about before. The values that will enhance your customer experience and provide real value to the economy: simplicity, transparency, honesty and fairness, trust and empowerment are values that I think can provide a firm foundation for avoiding the problems, the downside risks of regulation, and enhancing the ability of you to serve your customers. And these values sometimes require more financial innovation. These values require meeting the needs of consumers where they are and how they are. So disclosure, we know, can sometimes be useless. Disclosure can be a mountain of paperwork designed to deal with the compliance lawyers and not to actually provide valuable information to consumers. Disclosure can sometimes be even worse than that. Sometimes disclosure can mistakenly enhance the trust a consumer has in a firm that is taking advantage of them. There have been studies that show, for example, if a broker reveals to a client that the broker might have conflicts with the client, worse outcomes result because the client now trusts the broker more, not less, because the broker's been honest. And the broker feels more empowered to help the consumer, to perhaps take advantage of the consumer instead of helping them because the broker has revealed that he has this potential conflict. So we need to figure out ways of making disclosure empower a consumer and rightly enhance trust because it is earned, because the information being provided is valuable and in the interest of the consumer. And the peer-to-peer space has some special ability to do that because of the peer-to-peer networks that are created in this space that enhance the social network effect, that enhance the trust effect. But that trust can be lost. That trust can be lost if the consumer does not feel appropriately that the firm is responding in a way that meets that basic human need. So one example of this is work that Lending Club has been doing to improve the ability of consumers to use dynamic disclosure tools. The CFPB, the Consumer Financial Protection Bureau, provides a channel for experimentation in disclosure with safe harbors from disclosure rules. And one channel might be to provide a more dynamic disclosure that explains to consumers the different choices they make and what the potential consequences of those choices would be. How do they get a better loan? How do they arrive at a better rate if they improve their own performance based on their own past behavior? And what could they do to pay off their loan in an earlier way, either by paying it off faster over time or paying off in a lump sum or increasing their monthly payment. So all of these dynamic disclosure techniques are a way of empowering consumers consistent with that basic value. So really, this is what I want to leave you with. All of us in this room want to create a financial space that better meets the needs of American consumers and global consumers, of American businesses and global businesses. We want to have a system of financial education and regulation and innovation that meets those needs and that helps people do what they really want to do, which is, again, not pick a financial product, but lead their lives and achieve their aims and goals and hopes and aspirations. And you can help them get them there. And I think this is a very exciting time for you and for the online lending industry. And I'm happy now to answer questions for at least 7.5 minutes. Thank you very much. It sounds on.
Better now?
Yeah.
Okay. In talking about behavioral economics, to me it brings about the question of how exactly do you appropriately measure that? Especially when you're dealing with regulation. Businesses have to abide by things that they can track and they can measure. Whereas behavioral economics and the behavioral idea tends to be more of almost an opinionated factor depending upon who happens to be in power. So I think that's a challenge for the regulators, but also for the industry. When you look at things like disparate impact, how do you measure that? Things like reputation risk, how do you measure that? The answer is you really can't. It's in the hands of the regulators CFPB, which has a fantastic charter, you really stand up as an organization that really becomes nothing more than an activist for whoever remains in control. As someone who helped architect Dodd-Frank and created an organization like the CFPB, how do you balance that out? How do you work regulation with things that are very difficult to measure and very difficult to communicate to the industry, and put that in the hands of the actual players in the market who can then use that to track and make sure that they are staying on the straight and narrow, and in the end, helping the consumer?
Yeah, so I think that it's really important, it's incumbent on financial regulators to base their decisions on empirical data. And there's actually now lots of empirical data on behavioral economics. There's now 30 years of insights from psychology and from field work and from experiments. I think that the CFPB needs to continue to use its authority to permit pilot experimentation with safe harbors to explore new ways of doing things. And then at the end of the day, the agency needs to decide and put forward rules that permit ready compliance in the financial industry. So the industry needs clarity on a number of points. It doesn't always get those right at the beginning, but I think that it gets them reasonably well by the time the rulemaking process goes out. And the notice and comment rulemaking process that we have in this country, I think, is a reasonable way of getting input from the financial sector into that rulemaking process. So I think level playing field, certainty in the market, innovation, and behavioral economics, those go hand in hand. Those are joined. Those are not in opposition to each other.
Stuart Stoyan from Money Place Australia. Great presentation.
Thank you.
Agree with you entirely that financial education is something that needs to be a focus for the industry. And not just education, but raising financial literacy and really helping people to understand. Who does that well? You mentioned Lending Club, but more broadly within financial services, who do you see that really is taking a leading position in this?
I think we have a long way to go in making financial education work well and work systematically well across the financial industry. I don't see anybody in the market right now where I say, that's exactly the way I would do it. That's a gold standard of finance. But I think there are factors that indicate when financial education is more likely to be successful than less likely. So more likely to be successful when it is quite targeted on a particularized financial decision that has to get made. And much more likely to be successful when it is linked to a set of product choices that make sense for the individual. And then more likely to be successful when the education includes steps to actually put in place what the financial education would suggest is the right step. So that's why I mentioned efforts to use automatic payment of bills as being an example where just telling the person paying their bills on time, not that effective. Setting up automatic payment for them, that's pretty effective. So having that integrated into financial education, I think, is a key and important step. And I think that the online space has the opportunity to reach people at the moment in which they are focused on a financial decision and to tailor the financial education to their particular circumstance in a much more micro way than in the kind of old school brochure world or classroom world of financial education. So I think there's the potential, it is as yet unrealized to really effectively do that.
Can you talk a bit about how to set up a friendly collections practice and how behavioral economics comes into that?
Sure. So I think that the collection side of the thing is where a lot of complaints end up happening, obviously because consumers at that moment in time are under enormous stress. And they know things are going to go badly. And the question is just, do they go badly in a way that has horrible consequences for them, or do they go badly in a way that helps them build back out? So trying to understand where consumers are at that moment and avoid turning them into ostriches that stick their heads in the sand, and help them see a path forward that is going to be a decent outcome for them, I think is the strategy, that the sort of strategy that will be better for the company and the strategy that will be better for the consumer, and that is going to be more likely to be consistent with the high road expectations of the regulators.
Because feedback is one of the keys to the CFPB being successful. And how do this conference is an outstanding way for them to collect information on what's working. Are there any associations, or is there, because I know we do a lot of legislation in our spaces, the independent real estate investors. Is there something for the small entrepreneur, because that was what the act was about anyway, was to help them become more successful, create jobs. Is there a mechanism, or is there an association that represents the small online entrepreneur, which is really what we all are? We're not B of A here. Is there a mechanism, or is there an association or a group that represents us in that communicating with CFPB?
Well, I think one way of communicating is directly with the agency. So the agency has small business processes, ways of receiving input on rulemaking. The notice and comment rulemaking process is key. And I think the agency has been quite open to receiving communications from the industry and the public about all aspects of its approaches. I'm not really in a place where I can recommend to you about how you organize. But I do think that you should take advantage of the openness of the agency to that kind of input in a more coherent way, so that the agency knows what the key issues are in this space and how to help empower you to empower your consumers. I think that the Bureau would like to be in a place where the regulations are creating a level playing field that works for consumers. And if it's doing something that makes it hard for you guys to do your jobs in serving your customers, I think they would want to know that and would be open to it. I am 42 seconds over time, so thank you very much.